Imagine you just paid off your credit card. Zero balance. You feel good about that. Somewhere inside a bank, a computer flags your account. Not with a celebration, with concern. Because a customer with no debt is, from the bank's perspective, a customer producing nothing. That discomfort you just felt, that's worth sitting with. The US banking system, the one that holds your mortgage, your car loan, your student debt, your credit card balance, is not designed to help you get out of debt. It is designed to make sure you never fully do. Not through conspiracy, not through some smoke-filled room, through something far more mundane and far more permanent. It's just math. And the math only works if you keep borrowing. Why this matters right now. Total US household debt crossed $17.5 trillion in 2024. Credit card balances alone hit over $1.1 trillion. That's an all-time record. Student loan debt is hovering near $1.7 trillion. Auto loans, another $1.6 trillion. At the same time, the Federal Reserve raised interest rates to levels not seen since 2001, which means all that existing debt got more expensive to carry. Monthly minimums went up, refinancing got harder, the escape hatch got smaller. And yet, new credit applications went up too. People borrowed more even as it cost more to borrow. That's not irrational behavior. That's a system working exactly as intended. To understand why, we need to go back to something most people never learned in school: how money is actually created. Here's the part most people get wrong. When a bank lends you money, it does not go into a vault, pull out cash, and hand it to you. It types a number into a computer. That number, your loan, becomes a deposit in your account, new money, created at the moment you signed the contract. This is called credit creation, and it's the actual mechanism behind most of the money supply in the United States. The Federal Reserve acknowledges this. Economists call it endogenous money creation. What it means in plain language is this: banks do not lend out existing money, they create new money by lending. Which means the money supply expands every time someone takes out a loan. And here is the trap buried inside that sentence. When a bank creates a loan, it creates the principal, but it does not create the interest. If a bank loans you $100,000 at 6% interest, it typed that $100,000 into existence, but the $6,000 you'll owe in the first year, that doesn't exist yet. It has to come from somewhere. It has to come from the economy. It has to come from other people's debt. The uncomfortable math. Think about that at scale. If every dollar in circulation was created by a loan, and every loan comes with interest that was not created, then to pay back all debt, the economy needs more dollars than currently exist. So what happens? People take out more loans. Businesses take out more credit. The government issues more debt. The cycle expands. The pool of money grows just enough to let some people pay interest, but never enough for everyone to pay it all off simultaneously. Debt is not a bug in the system. Debt is the system's fuel. This is not a theory from the fringe. The Bank of England published a paper on it in 2014. It was direct. Banks create money when they make loans, and this process is what drives the money supply. The paper was largely ignored in public conversation, which is fitting. Now zoom into a household. You take a 30-year mortgage, say $400,000. At a modest 6% over 30 years, you will pay back roughly $860,000. You borrowed $400,000, you returned $860,000. The bank created the $400,000. The extra $460,000, the interest, had to come from your labor, your time, your wages. That money represents a real transfer of wealth from you to the institution that typed a number into a computer. That's not a criticism, that's just what it is. But it does change how you think about debt. It's not just a financial product, it's a claim on your future income, and the banking system runs on accumulating those claims. The fractional reserve layer. There's another layer to this. Banks don't need to hold all your deposits in reserve before they lend. Under fractional reserve banking, they hold only a fraction, historically around 10%. In March 2020, the Federal Reserve eliminated reserve requirements entirely from most U.S. banks. Read that again. There is currently no minimum reserve requirement for the largest banks in the United States. What constrains lending now is capital requirements. How much of the bank's own equity is on the books relative to its risk-weighted assets? But equity can be managed, assets can be classified, risk can be argued. The incentive to lend is never been higher. The structural brakes have never been weaker. Banks make money on the spread, the difference between what they pay depositors and what they charge borrowers. Your savings account pays you 1%. Your credit card charges you 22%. That spread is not accidental. It is the business model. And the business model requires you to carry a balance. A credit card that gets paid off every month is, to the issuer, a slightly annoying piece of accounting. The profit center is the revolving balance, the customer who pays minimums for years. The credit score mechanism, quiet genius. Here's where it gets elegant in a slightly sinister way. The system needed a way to keep people engaged with debt even when they didn't strictly need it. So it invented a metric that makes debt participation feel virtuous: the credit score. You are rewarded with a higher number, with better loan terms, with social and financial access for using credit responsibly. Not for avoiding credit, for using it. A person with zero debt and no credit history is, by the FICO model, essentially invisible, unscorable, treated as higher risk than someone with 5 open lines of credit and a consistent payment history. The system grades you on your willingness to play the game. Landlords check your score. Employers check your score. Insurance companies in some states use it to price your premiums. To exist comfortably in American financial life, you need a credit score. To have a credit score, you need to be a borrower. Circular? Absolutely. Accidental? That's a harder question. Hype versus reality. The financial industry is very good at framing debt as empowerment. You'll hear phrases like leveraging assets, building wealth through debt, using other people's money. And there is real truth in that for certain people in certain situations. Real estate investors who borrow at 5% and earn 8% returns are genuinely using the system intelligently. Businesses that use credit lines to manage cash flow without losing equity are making rational decisions. But that is not the average American's experience of debt. The average American is carrying credit card balances at 22% interest, is refinancing student loans they took at 18 because a university told them it was an investment in themselves, is rolling over auto loans from one vehicle into the next without ever reaching zero. The wealth-building debt is available to people who already have wealth. The predatory debt is sold to everyone else. And the marketing is designed to blur that line. Buy now, pay later. 0% for 12 months. Pre-approved offer inside. The language is always friendly, always convenient, always positioned as the borrower's choice. It is the borrower's choice, but the choices are curated. The bigger picture, systemic implications. Zoom out further and the stakes get larger. The US government itself operates on this logic. Federal debt has crossed $34 trillion. Every year, the Treasury must issue new bonds, new debt, to pay for existing obligations, including the interest on existing bonds. It is, in structural terms, a debt that can never be paid off. It can only be managed, refinanced, and grown. The economy is not designed to eliminate debt. It is designed to sustain it at levels that don't trigger collapse. The target is not zero. The target is manageable, serviceable, contained. Until it isn't. 2008 was a demonstration of what happens when the debt load becomes unserviceable at scale. Mortgage-backed securities, subprime loans, the packaging and resale of debt into financial instruments so abstract that the people holding the risk had no idea they were holding it. That wasn't recklessness from outside the system. That was the system optimizing itself until the optimization broke